So I want to go back to the Great Recession that began in 2008. It seems like a long time ago now, but it is the most recent big economic crisis that the world had to deal with. Although the crisis of the pandemic era is also a case worth looking at. This was a big global recession and raised a lot of questions. So let's talk about a little bit about what happened. One of the things that made the Great Recession so difficult from a global perspective is that in previous recessions since World War II, everybody had relied on the United States to sort of drive a recovery package. And in this case, it was the United States itself that was the source of the economic crisis because of the housing crunch. So just to overview things, a collapse in the U.S. housing market led to a broader U.S. financial downturn. U.S. consumption fell. U.S. imports, therefore, fell. Others around the world, therefore, weren't able to sell as many goods in the United States. And all that then led to layoffs around the world, assets losing value. Billions, if not trillions of dollars were lost in U.S. financial markets. And, of course, investors from all over the world invest in those markets. So when things went bad in the United States, people around the world very quickly found themselves feeling poorer, and financial institutions around the world suddenly found some of themselves in much weaker positions, so that, again, some of them worried that they weren't going to be able to pay all their debts. Where will the plan to resolve the crisis come from? And where will the money come from if the United States is part of the problem? Well, the U.S. still played an important part of the solution. And it was part of the solution basically via its monetary policy, which was the United States sought through monetary policy, that is to say, lowering interest rates almost to zero and then printing, essentially, emitting lots of currency, basically tried to drive up demand in the United States as a way of helping the United States get out of its recession, but by extension then jump-starting the global economy. China played an important role as well. And again, it was a self-interested role that also had a good effect on the others, which is China, because it was enormously dependent on exports to the United States, and people in the United States all of a sudden had a lot less money to buy things. China was worried about what was going to happen to its consumption, and so it started pushing money into its economy to essentially replace American demand with government spending, and so that helped. And then the European Union had a whole set of programs that were really operative within Europe, and I'm not sure had as much of an effect beyond Europe as the U.S. program did, but certainly played an important role in preventing a real disaster in some of the European countries, which then would have had repercussions around the world. So one of the problems that the United States and the European Union faced was that they used monetary policy. That was what they had been using for a long time. So they lowered interest rates, but still the recession went on. And they lowered interest rates, and still the recession went on. Well, interest rates got down to zero. And interest rate is basically the money, the interest, it's the payment people have to make to borrow money. So when you think about, well, can you push interest rates below zero? It basically means that you're paying people to borrow money from you. And it really doesn't work. So once interest rates got close enough to zero that basically they couldn't have any more impact on the economy, a couple of other means were used. One was, rather than doing monetary policy through interest rates, there was this policy known as quantitative easing, which essentially was the Federal Reserve or the European Central Bank using newly created money to buy assets. So they bought in assets, and then they were putting money into the hands of the sellers, and the sellers could then go spend that money. The other thing that was a big a part of the U.S. package was fiscal policy, which was the United States took on an enormous program of deficit spending to try to essentially spend money on things like construction projects to put unemployed Americans back to work, understanding that not only did that put them back to work, but then they would go ahead and spend money, and that would increase aggregate demand in the economy. And eventually this worked, of course. But it took longer than most people thought or hoped. But one of the problems with monetary policy in a global economy is when, and with fiscal policy as well, is if the Federal Reserve pushes a whole bunch of money into the American economy, and the goal is to stimulate demand in the American economy and have that increased demand, what happens when the Americans use that money to do what Americans typically do with money these days, which is buy stuff made in China? So now the money very quickly is flowing from America out to China or to other countries that we import stuff from. So the big point that we're getting to here is that in a globalized economy, the effect of one country's monetary policy is diluted by wherever that country's people and economy are importing goods from. And so in order to have a monetary policy really work, you want not only the United States to be doing that and stimulating the Chinese economy by extent, but you want the Europeans doing it so the Europeans and Americans are stimulating each other, and so on. One of the problems with this, as I'll get to now, is the Europeans were not so devoted to some of the same kinds of policies. So Europe had this enormous debate. And the thing to recognize about Europe that was crucial is, in terms of monetary policy, many, not all the countries of Europe, many of the countries of Europe shared a single currency. So they could only have one monetary policy. But they had very, very different economic situations. Southern Europe, Greece, Italy in particular, but also Spain and Portugal were in real trouble. Germany and some of the other Northern European countries were in less dire straits. And so it was hard then to come up with a single monetary policy a single monetary policy that fit both the needs of Southern Europe and Northern Europe. And so there was a big debate about that. The question then, particularly for those countries, is, well, what do you do about deficit spending? The countries in the South wanted to do a lot of deficit spending, but that, of course, was going to run up deficits in their government spending, and the worry was that eventually they might not be able to pay that money back. In other words, Greece was accumulating a great deal of debt. Italy was accumulating a great deal of debt. Spain and Portugal, slightly less so. The worry was that they wouldn't be able to pay it back. But they were using that debt in part to bail out their banks, which were in big trouble. So on the one hand, if you didn't bail out the banks, you were going to have a European crisis, right? That was going to spread because German banks were invested in Spanish banks and so on. But if you did bail them out, then you were going to have some problems potentially in the national borrowing. So the argument in the South was, we need to borrow all this money. In the North, they were saying, wait a second, we share a currency with you. And if you, through your potential debt default, ruin our currency, we don't like that. And so we don't want you to do that. What they said those countries need to do, in fact, is not keep on spending, but cutting their own government spending as a way of dealing with their problems. In Greece and Italy and so on, they said, our people are already struggling with this. We need to pay more unemployment insurance. This is not the time for austerity. And a lot of economists, most American economists, agreed that this was not a time for austerity, that would drive everybody even further into recession. This was the debate they were having, and there's a lot of other politics behind it. So the problem in Europe was on the one hand, you didn't want to borrow too much money because that would lead to a debt crisis. On the other hand, if you didn't borrow that money, you would potentially have your economic crisis get worse and worse. And that was really the dilemma that Europe struggled for several years to sort out. And it was compounded by the fact, again, that while all these countries were linked together in their monetary policy, they had completely separate government spending policies, which meant completely separate fiscal policies. So that's a brief overview of how some of the different countries of the world dealt with this 2008 crisis. And by way of summary, I would say there was not a lot of coordination. And so that crisis endured for much longer and was perhaps much deeper than it needed to be, because there was not a clear, agreed international way of dealing with it, and of course because the country that again had generally thrown up most of the money to resolve previous crises in that moment didn't necessarily have money for other countries because it was worried about itself.